Hello and welcome to this market special from Business Today. I'm Udayan Mukherjee, and with me is our special guest for the day, Shyam Sekhar, founder of iThought Advisory and a veteran of many decades for the stock market. Shyam, it's very good to have you on the show. Let me begin by asking you a general question. We've had a 1,000-point pullback in the Nifty from the recent lows. How are you reading this period of respite for the market?
I think the markets are just recovering from a one-way movement which we saw in May and some part of June. Um, I believe that what we had factored in before the Ukraine war and what we see now, there is a gap, and I think the markets will have to fill that gap sooner than later. But as you know, markets will always be non-linear in changing its stance also. So it went one way down, it's again going up. Probably somewhere it's again going to realize that the valuations may not justify where we are and it may again take another direction sometime soon. But for the moment, I think this is more kind of a reaction to the sustained fall that we saw in May and a good part of June.
So you think this volatility will be with us for some more months to come? I mean, what's your sense of how much deeper the cuts could be before we are done with this ordeal? You sounded quite circumspect about valuations and whether we have seen or made a final bottom already.
Well, I think that the valuations will need to adapt to the emerging scenario, which means that volatility will be there for some more time to come. We also have numerous policy responses by various countries to the inflationary problem. The stock markets will naturally react to every single policy response. Like when you saw the export duty on metals, the stock market took a very nasty fall subsequently. Similarly, whenever you see bad news coming on inflation from the West, we will wake up to a rattled stock market. So it's not going to be easy times at all. It's going to be very difficult to predict, and volatility is a given for the imminent months to come.
Okay, we'll talk about the macro triggers in greater detail. But first, tell me, how are you approaching this period, this uncertain period, from a portfolio construction point of view? What kind of stocks are you including to ride out this phase? What kind of stocks are you setting aside as the ones that you would not like to touch?
Firstly, I think that the portfolio that we are building now will have to deliver over an extended period of time. The way I look at it is that the markets are going to continuously react to near-term trends and expectations for some more time. So this is a good time to be bottom up, to be very specific on stocks and sectors which we like for a holding period of 3 to 5 years, and to align our portfolio to buy such stocks. Let me give a parallel. In 2010 also, post the GFC, we had this kind of a volatile phase, and you're very familiar with that. During that phase, what I did was to look at businesses beyond the immediate 1 or 2 years, and we bought business which we felt will do well over extended periods of time. So we did not have to bother about the immediate reaction of the market to the stocks. Just stick to the bottom up approach, look at individual companies, identify companies which will grow for an extended period of time, look if the sectors are reasonably stable and whether we could expect that stability to sustain for a longer duration of time. And based on that, construct portfolio of such companies. So we did not have to worry too much about the near-term trends in the macro. So we were able to put the macro aside and focus on companies and their fundamentals and the relative attractiveness of companies for the longer term. So that basically helped us to build a portfolio and at the same time manage the macro volatility by sidestepping it. So that is precisely what I would do now as well for the next year or two. Be very company specific, be very sector specific, be bottom up, and bet on companies which will do well once this volatility settles and once the macro headwinds are behind us. That would be the broad approach.
Right. Can you illustrate this strategy with just one example, Shyam, from what you've been doing in recent times? An example of a company which may be volatile over the next 1 year in terms of a stock price, but one that you are confident about in the next 3 to 4 year kind of a time frame, where wherever the stock bottoms out, eventually it will generate returns. I mean, that will help our viewers understand what you're talking about.
See, a very obvious example could be a large cap company like a HDFC or a Larsen& Toubro, which are going through a little bit of, negative sentiment at this point in time. But these are companies which are very, very strong. Fundamentally, they are very, very material to our economy. They are capable of giving us sustained growth over longer periods of time. The markets are not liking them in the near term. Typically, when you look at these companies, when they are trading either lower than their historic valuation multiples or not factoring in the changes which the company has done over the recent years to make themselves less levered and better equipped for growth, we are going to get these companies at valuations which we normally don't. So typically, I would buy businesses like that, which would stand their ground and deliver superior returns when the economy goes back to growth and these companies are able to participate significantly and materially in the growth.
Do you find such companies today in the mid cap and small cap universe as well, or is there a distinct large cap bias because of the uncertainty and the volatility in the environment?
No, it is possible to identify companies in every space. For example, in the mid and small cap space, I would think that companies which are in the industrial goods space are likely to do extremely well for extended periods of time. You are very well aware of the kind of infra investments that we are seeing over the last 2 years, and there is visibility of such investments happening for the next 2 to 3 years as well. Given such visibility and given the fact that the cap goods cycle will also slowly start and gain momentum, given that we see already that order books of many of these companies are at 3 or 5 year highs, most of these companies which are in the industrial goods space, be it in welding, in refractories, in motors, in transformers, all of these companies in the small and mid cap space should be very, very interesting to look at. That is my sense.
What are you avoiding in your portfolio right now, Shyam? I take your point about what to include, but what would you not include over the next year or so from a portfolio construction point of view?
I think that for the moment, I would not include chemicals. I would not include specialty chemicals. I would not include companies which did extremely well in the recent 2 to 3 years, which saw not only an earnings expansion, but also a significant expansion of PE multiples in the recent past. I think that I would stay away from companies which are trading at high earnings and high multiples, because if there is a change in any of these, either the earnings contract a little bit, or if the multiples contract, or if both contract, then we would see an adverse impact on the portfolio. And I expect that the markets may run out of patience in some of these companies, and that would reflect on these companies' valuation. So I would stay away from such companies which are trading at extremely high valuations around their peak earnings from FY 21-22.
Speaking of earnings, Shyam, there is a concern in the market that over the next 4 quarters, 3 to 4 quarters, you will see earnings downgrades coming in. And the recent numbers from TCS seems to have worried the market a little bit because of the margin compression, the tepid kind of order book growth. Do you have concerns about large cap IT, or would you be comfortable owning them using the principle that you just mentioned of a 3 to 5 year holding time?
Well, then I think IT has swung very fast from being a consensus trade to where it is today. Today, it is more a concern trade. So I think that when you see a consensus trade turn so fast into a concern trade, you must slow yourself down and you must build your positions over a period of time. These are companies which are very, very strong, which can grow and which can overcome the near-term headwinds and come out successful. But it matters how we buy these companies. So I think that you should buy these companies gradually as valuations become more and more lucrative, and the positions must be built over a period of time. So I would not rush to complete building a position in IT companies, especially the large cap ones. And as far as the mid and small cap IT companies are concerned, I believe that I would avoid them for the time being. I would wait for more positive validation before I consider investing in those companies.
So you think there is more room for valuation compression in mid cap and small cap IT because they have corrected. I mean, they have shed some of their PE multiples, but you think the likes of Mindtree, L&T Technology, etc., might actually cool down even further in terms of valuations?
It's hard to predict, but the point is that many of these companies are trading above their historic multiples. They are trading above their historic multiples. So if the companies are able to individually sustain their growth and meet expectations, in some instances beat expectations, then those individual companies may be able to sustain their valuations. But if there is even a small disappointment, I believe the market is going to be very reactive. So that is something that one must keep in mind when he invests in smaller companies. So that is where the larger companies are a safer domain to look at, because gradually you can build your positions and you would be able to wait and build. Liquidity is not going to be a concern. You're not going to miss anything. So in that sense, smaller companies are not only going to be more volatile, but they're also going to have very high impact costs, both sides. So it is a space in which, unless you have complete conviction and certainty on your idea, you must be very circumspect. You should wait and take your decisions with full conviction.
Let me ask you about Telecom, because today the market was in a bit of a tizzy with talk about Adani bidding for 5G spectrum, and Bharti took a big knock because people feared the same thing which happened with cement stocks after Adani's announcement will now happen in the telecom space. How do you read that development? And I mean, what would be your approach to names like Bharti now?
I think that first they need to invest money in buying the spectrum, then they need to bring that spectrum to commercial use and then create revenues. Bharti is a company which has a loyal customer base and it has a very good customer base. They are the better customers in the telecom space. They have weathered the entry of Jio quite competently. So I think that Bharti is not a company which I would be worried about, but a space in which such heavy capex is required, where you need to invest so much of money before, and then you need to wait for that money to come into productive use. I think that that gestation is there, right? In that sense, telecom is a space in which one should not rush to invest. If you have existing investments, I would sit with them. But to scale my investments, I would be very measured in what I do, because history, what happened when auctions happened and how auctions changed the course of an industry itself. And telecom is a very good example of that. The entry of a very aggressive player and a late entrant with a higher risk appetite always smells risk. And that is what happened with Jio. You remember what the valuations of Vodafone was prior to the entry of Jio and where it came. It lost close to 96% of the value. And I think that that is something we need to remember. The more resilient companies that we see today, like Bharti, may not lose like what happened in the past, but still, for them to make money for us, it could be a long while, or you need a lot of validation that things are very good in some parts of the business and those will chug along smoothly. The uncertainty is something we need to factor in when we buy such companies under the circumstances.
Let me ask you about autos, Shyam, because that sector has woken up from a stock market perspective, at least after a long time. Stocks are up 30-35% from their recent lows. But the one which has caught the market's imagination is M&M after the recent deal they did on the EV front. How do you look at that stock, which has been actually in a range for so many years, but is now promising to break out with the hope that they will be one of the front runners in the EV game? But how would you consider it?
Broadly, I like the auto space, and M&M as a company has a new leadership in place, and they mean business. They're launching new models. If you see what they looked 1 year back and what they look now, the company looks far more confident. Yes, their tractor space is looking a little sluggish at the moment, but a good monsoon can change all that. Overall, the company has shown resilience to come back out of such a difficult phase like COVID. They do have an order backlog. Their models are all being received well by the market. So, overall, I think the company shows far more promise today than they did a year ago. That is my sense about M&M.
It's not just the stock market which is volatile, Shyam, today. The currency market is something which is actually concerning greater number of people today. But from a portfolio perspective, do you keep an eye on that, on what the rupee dollar is doing or what the rupee yen is doing? And does that have any kind of bearing on the kind of stocks you've been leaning towards of late?
As an investor, I think you can never overlook currency risk. India has two sets of opportunities. One is businesses which benefit from a better value for a rupee, and businesses which benefit from a weaker value of the rupee. I think portfolios should have a good balance between these two. Under the present circumstances, I think that businesses which benefit from a weaker rupee must have a slightly higher weightage in our portfolio, and over a period of time you can always change it when you see evidence. But at the moment, I think that the rupee is definitely a concern. I haven't forgotten 2012-13 and the events and how things change rapidly. It's very hard to forget past instances, and I think that one should always be vigilant and cautious. So I would not bet that the rupee will be very strong, or I would not bet on things very drastic. At the same time, I would be very, very cautious about an event like we saw in 12-13, and though the circumstances are very different and we have much higher reserves, it's important to have the right balance in your portfolio. And I would think that having businesses which generate dollar income today dominate your portfolio over businesses which generate rupee income is very, very critical.
What is the biggest risk to this market, Shyam, in your eyes right now? Because many of the things that we talk about today as risks are known to the market in a sense. Maybe their magnitude is not, but the fact that there is an inflation scare, that the interest rate hikes will lead to some kind of a growth dip, maybe even a recession. These are not going to be surprises for the market. So in a sense, are these still the risks which can bring the market lower, or do you feel that there could be an accident which we cannot see today because of the way interest rates might go up in the West, or there could be a massive retail pullout of money in the Indian market because of continued volatility? What do you think can bring the market down substantially from here? I mean, what tops your list of worries today?
I think the way the Western countries battle inflation is a cause of concern. The way they battle their energy requirements is a cause of concern. Disruption in the West will definitely find reflection here the next morning. That is my primary concern. India's fight against inflation so far has been reasonable. There's no cause for alarm, but at the same time, if the West has struggles in its fight against inflation, if oil does not come down anytime too soon, if the energy requirements of Europe are secured before the winter, then we'll probably see these worries wane. But if they're not done, then I think that one should always be cautious, and we should always be well prepared for some event in the West which could come and affect us. You also have rising interest rates for which US is surely not prepared. I don't think the American investors or the borrowers are prepared for this kind of a reset in interest rates. And if there is a need for a sustained rise in interest rates in the US, I think that should be a primary worry for all of us, because that will reflect in the global markets, and we cannot be excluded from the consequences of very high US interest rates. So that is something which we need to be always concerned about and cautious about.
Shyam, very good to hear your thoughts today. Thank you very much for being part of this show.
Thank you, Udayan. It was my pleasure.
If you like the video, do like, comment, share and subscribe.